Okay, so today's slightly shorter, and I wanted to cover with you guys a concept of liquidity. So, where does liquidity build up, and what is liquidity? Essentially, liquidity refers to an area where there's a bunch of stops or a bunch of volume, essentially, of trades or orders um, to get stopped out or to get executed once price reaches that level. Now, why is that important? Well, it's important because a lot of big money or smart money um, tends to drive price to these levels to stop these people out or fill their orders and then counterfill those orders with whatever orders they want filled. So essentially, to rephrase that in a way is if a smart money group wants to get out at a level, and let's say the price is like this, as is now, or let's say here, and they know that there's a bunch of people that are short with stop losses over here. They want to drive price up to that level, stop these people out before they re-enter more short positions during this process and actually drive price down, right? So I want to kind of enable you guys to locate these spots of liquidity and in the market and kind of see the different ways with which or how you can actually locate these levels, or at kind of a probability thing of where these levels usually occur. So the first one is going to be a level at which there's equal highs. So the reason equal highs are often going to be kind of like a magnet for liquidity grabs such as this is because a lot of people think double tops are like the holy grail of confirmation of trend change. This is actually completely not the case. They often get tested, and we're going to see that here in a second on the chart. We're not just tested; they get broken through, and we're going to see that here in a minute on the chart live when I show you guys. So how do you identify an equal high? Well, it's pretty simple. You just you look at if the top of one candle is equal to the top of the other candle, and then I would make sure you get a preset such as this, right? And then you mark that equal high through templates, and then you can mark the equal highs, and then you can look for liquidity to kind of, or for price action to kind of come and break through this. Now, what you might say is, hey, look here, let's say we're in a downtrend. Let's say here we have a break of structure or change of character. Now, this usually won't be the case. Usually, just because there's an equal high that got broken through, that usually is just a liquidity grab. So here's not where you want to enter some type of breakout trade. You'd rather wait and see if the trend continues towards the downside, as was the trend before. Kind of, as you can see, there was a downtrend, and then this downtrend should have continued, but the liquidity grab, and after that we continue. So that's kind of what to look out for when it comes to that. So this is kind of the inverse of that same concept. It's essentially there's a prevailing trend, which is, let's say, an uptrend. Let's just draw it out like that, right? And then there's equal lows, and then we continue the uptrend before we come and kind of stop these people at these equal lows out and continue the uptrend as expected, so to speak, right? So let's just draw this out like that, right? And then we continue the uptrend as expected. So again, the same thing as with equal highs. Do not try to enter here all of a sudden be like, hey, there's a change of character, and so after equal lows, if you see a change of character, wait for some type of confirmation for this to then kind of do this and then start entering shorts, right? The reason is that these are often fake outs, where what you'll see is this kind of do what we drew out here, where the trend upwards continues, but there is a short break of structure here to kind of stop out these people who thought they had great stop loss levels right here. That's essentially it. Yeah, so a lot of people put stop losses at these equal low or equal high levels that tend to get stopped out for the exact reason that people with bigger money, more money, bigger capital investments can actually drive price action to these points that are super obvious for stop losses and kind of drive you out. So if you do enter a trade like this one, put your stop loss under, let's say this is the previous low, under this one instead. That's another idea. If you do want to trade these trades, I would just avoid them since these are obvious. These are often spots that price action kind of drives itself towards through bigger investors that you kind of don't want to counter trade. So what you can also do is you can literally take a short. Let's say there's some shorter price action like this in between here, and then take a short here because you expect these equal lows to get taken out. Now that's how I tend to actually trade equal lows and equal highs. I tend to expect them to be taken out. So I usually like enter somewhere here to enter short because there's some form of previous resistance. And then we tend to take these out. That's where I take most of my profits. And then I try to like see along the way here and put like a trailing stop loss or some type of reason that once we break the lower time frame structure like this, that I have a stop loss right here. Right, but all of that in a second. And then finally is a more general concept of liquidity, where liquidity builds up without it being an equal low or equal high, is essentially when you have price action that is kind of consolidating around this area, as you can see. Right, so we're kind of stuck here for a bit. This is where a lot of positions are actually building up before we get a major move. Right, so these moves right here, this, and then let's say this, turns into imbalances. So price is going to want to retrace this anyways. Right, and we're going to get a video on imbalances here in the next few days as well, so just keep an eye out for that. If you don't know what imbalances are, they essentially refer to spots of like areas of price action that haven't been tested whatsoever since the drop or since the rise, right? So essentially price is going to want to retrace some of this and test, like, let's say an order block up here. That's what you'd expect, and then we continue the downtrend. Now unfortunately or fortunately, if you are aware of liquidity, what is going to happen is there's so many shorts, right? And you have to think of it literally like dollar bills. That's why it's up there. But here's shorts. And there's so many people that are short above here and all these stop loss levels that institutional money would want to drive this price back up, which is going to retrace a little bit anyways. And essentially, even if it's just a wick, and often it is just a wick, kind of spike it over these levels and stop a lot of these stop losses that are up here, often way too close to this level, kind of stop it out, or like do this and then just continue to crash down, right? And then you have this might be a bit large in my opinion. This is often not how large this is, more like this one, but yeah, just kind of go slightly over this level and yeah, stop you out. So that's what you should be looking at with liquidity in general. So kind of look at areas that have a lot of consolidation and sometimes even something of the sort where it is like price action literally returned, tested these order blocks, and did even more consolidation within that same area. And then later on, you're going to see some type of spike over it down the stretch. So to see this in practice, I just drew out some levels here. I don't know what that is. I think this is it. Right, so I only have one example of liquidity, and you can essentially move this liquidity line, or I can draw another one somewhere like here, where you can see that this area has accumulated a lot of stop losses. Even better would be right here, to be honest. Has accumulated a lot of stop losses in the short term. Like every time we went up here, people are getting short, putting stop losses above this. They retest here. People are getting short, putting stop losses above here, are in profits, and a lot of people don't close profits at these levels and remain in shorts because they expect even lower. Again, they come up here, they stack up on stop losses and on shorts, and then we see this, and maybe a lot of people take profits here, but a lot of people also still expect some move to I don't know, 15K, and this is where price just rallies right over this, stops all of these people out while people are still stacking short as well, and then they spike over to another higher level. Here's another example of this. So essentially, you could also mark this level, since with a spike like this on the 4 hour, you're going to get a bunch of people that enter short here that are kind of lucky to have entered. But additionally, you can see that all these spikes right here, a bunch of people entered short. So let's say we grab this spike as an example, right? All these people are entering short, and you can see that what we did here is we spiked over all these levels and kind of stopped out everybody that was entering short here and had their stop loss safely right above there. So these are kind of magnets. So what I would think of them, and again, here's an equal high, more or less, right? That has been stopped out after we see a spike to the upside here. Now, I would just look at the liquidity here, since that makes more sense than an equal high. And yeah, you could just see that there's people getting short on each of these spikes. So that's here, here, here. There's a bunch of stop losses. You could kind of, once you get a feel for it, you can just identify them with a blind eye. Yeah, and the same thing kind of here, right? You have people building up longs here, building up longs here after this big spike, thinking that we're just going to continue building up longs here. And then all these people that are in these longs and didn't close during the spike have their stop loss here. So price is automatically going to magnet down to these levels. So again, another great example of liquidity being under here, a bunch of stop losses. And price is obviously automatically going to want to retest these levels, or at least stop out these people. And before you know it, too many people are under here and want to close their longs, and you get this absolute waterfall effect. So let's trace it down. Here's another beautiful example of equal lows. So you can see we kind of trace here, put in a low, retest that exact same low, retest that low again. So every time we're here, we see an insane spike or some type of level of spike. So here you can see a crazy spike and we have a good price action. Right here, we retest that same level and you have very, very big rally. I don't know what these are, 20% or something, I presume. Right, yeah, 20%. So we have these rallies. And again, here we have a rally before this one is kind of weak, and we see a breakdown of these equal lows and all the liquidity that again is built up. So again, there's long stop losses here, long stop losses here, long stop losses under here, and automatically price gravitates to the level underneath it to stop these people all out, and then we see continuation to the downside. On a lower time frame, we have the same exact concept right here. Equal lows being built up here. So every time people getting longs, and before you know, you might even include this level. There's even more longs under here. So you can imagine, just like if you watch the order books or something of the sort, where you see essentially just the exo charts where you see where longs are at, and you can see that essentially there's going to be a lot of stop losses under that level. So price automatically gravitates to that level to break or to stop all these people out. And before you know it, we have this massive rally that everybody that was getting long here was hoping was going to happen. So they were hoping on this move, and they all got stopped out before this move actually happens, right? Which means that often institutions are the one making these moves, or smart money concepts or smart money traders would have taken this move because they understand there is liquidity under here, and liquidity usually gets taken. So make sure you are not part of this liquidity. Make sure you actually wait for some type of confirmation upwards or fine to get stopped out. But this does not mean there's a trend change. This means this move can still happen. So you can kind of grab it or to kind of navigate these moves more correctly once you know about smart money concepts and where liquidity is actually resting in the markets and how to kind of maneuver around that. So here we have a similar thing again. You can even include, instead of having equal highs, since they're not perfectly equal, and usually I want perfectly equal highs to mark that, you could better mark it as liquidity. Right, so again, we have this major move we just spoke about, and then we break down and we kind of consolidate here. So that kind of refers back to my example here, consolidation, liquidity buildup, right? So we kind of have this little bit of consolidation on the lower time frames here. liquidity buildup, a retest of that level, and then we kind of put in a low here. We retest that consolidation. We retest that consolidation again, right? So now you can imagine there's so many people that have gone short with a stop loss right above these levels, right? And then here we put in a low, and we put in almost exactly an equal low on a wick right over there. So that means that there's a bunch of people that during this candle got long and during this candle got long and put their stop loss right under that level, right? So now you just have to kind of visualize these red lines as people's stop losses, right? And before you know it, we consolidate within this range, which is essentially this range right here, right? A bit longer before we suddenly spike over this level and stop out all these people that had shorts up here, right? So these people gone, right? And again here, now I wouldn't really draw this one out, but you could draw this one out as like I just had kind of an equal high as an example, where there's stop losses above here, and again we spike over it very shortly before we have this major crash down that also stops out all these people that were in longs and hadn't closed their position, of course, right over here under these wicks, right? So we stop out right there, and you can see there's a strong move right afterwards, since these lows are supposed to hold or supposedly held before, kind of this 18K level. And again, you see this strong move, right? Strong wicks right at that same level, trying to hold these equal lows before they broke down. So we'll just kind of delete these two and drag this one out. As you can see, these lows were trying to be held right over there. And yeah, that's kind of it. So these are all the examples I kind of have now, and I could keep going for a while longer, but I think the idea generally is understood that there's three ways you can spot liquidity that often will get stopped out, which is equal highs or double tops, double bottoms. These tend to get some type of magnet, or tend to turn into some type of magnet for the market to come take that liquidity that often rests right above it. So usually it's just right there, and that's why there's a small move that kind of spikes over it. Same thing for equal highs, and then ultimately when you see consolidation or retest of similar levels the entire time, you can imagine kind of the buildup of stop losses that is being put above that level. So in this case, it would be like right here. You know, also people that just got short here, they kind of want to put their stop loss safer up here, or even up here. That's fine too, right? So this level in general, you can kind of imagine as a zone, is a zone that people are gonna get stopped out. So you would want to see, or institutional money would want to kind of just take out these short positions before entering short themselves, and essentially just acquiring more short positions than they would otherwise. So yeah, that's about it. I hope you can spot liquidity better in the market, and yeah, take better trades off of the fact that you know where liquidity will be and how price action tends to move to these levels. And as one last note, again, join everything, join the team, visit me on Twitter, where I do post a lot of things about trading and even more stuff about just success and success in trading, of course. One last thing, disclosure. Everything we do at Boomish Capital is completely solely for information and entertainment purposes. We are not financial advisors to any degree, and you should make your investment decisions yourself or with a financial advisor